Hello everyone, and welcome back to the Web3 Daily, where today, the market is giving us a real tale of two cities. On one hand, we're seeing price pullbacks and a massive liquidation of leveraged longs. On the other, institutional money is flooding in like never before. So the big question is, who's selling and who's buying? Let's break down the action. Over the past 24 hours, after hitting a new all-time high, the market seems to have a bit of vertigo and is now consolidating. Bitcoin touched a peak of around $126,000 on Sunday and has since pulled back to trade in the $121,000 to $123,000 range. This dip triggered a significant leverage flush, wiping out nearly $470 million in long positions. Ethereum took an even bigger hit, dropping about 6% to around the $4,400 mark. Most altcoins followed suit, with the notable exception of BNB, which is bucking the trend and continuing its strong upward move. But here's where it gets really interesting. You might think this is the start of a panic sell-off, right? It's the complete opposite. At the very same time that retail and short-term traders were getting liquidated, guess how much money flowed into spot Bitcoin ETFs in a single day? A staggering $1.2 billion. That number is insane. What this tells us is that the market structure has fundamentally changed. It's now a two-tiered system. On the bottom layer, you have us, the short-term players who are sensitive to price swings. But on the top layer, you have the Wall Street institutions coming in through ETFs. They don't care about short-term volatility. For them, a price dip is just a discount. So, in my view, this pullback isn't the beginning of a bear market. It's a healthy cleanse. The institutional buy wall is creating a solid floor, and as long as this fire hose of capital from the traditional world keeps flowing, the long-term trend is hard to bet against. The rules of the game are changing right before our eyes. So today's market action leads us directly into our main topic. There's a belief in our community one that's practically encoded in the DNA of every crypto veteran, the 4-year cycle theory. We've used the Bitcoin halving every 4 years to predict bull and bear markets, to decide when to go all in and when to cash out. But have you felt it? This market just feels different. Recently, a growing number of people, including research firms like K33, are saying it out loud. The 4-year cycle is dead. When I first saw this, my initial reaction was, what's the new narrative this time? But the more I think about it, the more I believe we might be witnessing a genuine paradigm shift. There are 3 forces at play that we've never seen in any previous cycle. First, and the most powerful, is the structural demand from spot ETFs. This isn't new information, but its impact might be far more profound than we realize. The institutional money flowing in through these ETFs isn't here for a quick flip. They're here for asset allocation. Their buying thesis is based on long-term value and macro hedging, which has very little to do with the internal narrative of the halving. This has essentially connected a perpetual fire hose of capital to the market, fundamentally changing the demand-side dynamics. Second, the players at the table have changed. It used to be retail investors and a few early adopters. Now, you have public companies like MicroStrategy buying Bitcoin as their primary treasury reserve asset. We're even hearing whispers about sovereign wealth funds getting involved. These players operate on a time horizon of decades, not years. They care about global inflation and geopolitics, not the 4-year rhythm of the crypto market. And finally, Bitcoin is now deeply intertwined with the global macroeconomy. Have you noticed? When we analyze the market now, the biggest question is, when will the Fed cut rates? Not how many days until the next halving. When Bitcoin becomes a macro hedge against the fiat debasement, its primary driver shifts from an internal supply shock to the external global environment. Of course, to say the halving is completely irrelevant would be premature. After all, a guaranteed supply reduction is real, and the 4-year cycle narrative is so deeply ingrained that it can become a self-fulfilling prophecy. So, in my view, it's not that the cycle is dead. It's that the game has leveled up. The market used to be supply-driven. Every 4 years, supply gets cut in half, and the market takes off. Now, it's become a demand-driven market. The scale of this new demand is massive, and more importantly, unpredictable. The amount of money flowing into ETFs in a single day can exceed what miners produce in months. What does this mean for us? It means the old playbook of waiting for an 80% crash to buy the dip might be gone for good. The future might look more like a slow burn bull market with less volatility and a much longer duration. For every investor here, our past successes and experiences might just become the biggest obstacles on the road ahead. Alright, let's dive into our first major story of the day. Payments giant Square, Jack Dorsey's company, just made a massive move. They've launched something called Square Bitcoin. And to put it simply, it means your local coffee shop, the corner store, they can all start accepting Bitcoin directly through their existing POS systems. But here's the killer feature. Starting November 10th, 2025, and running all the way through 2026, merchants will pay 0 processing fees for Bitcoin transactions. You heard that right. 0. Think about the 2 to 3% fees that credit card companies charge. For a small business, this is a game changer. On top of that, merchants can now automatically convert up to half of their daily card sales directly into Bitcoin. On the surface, this looks like just another payment option, but I think this is Jack Dorsey playing chess, not checkers. Bitcoin as a payment method has always been stuck in that classic chicken and egg problem. Consumers won't use it if merchants don't accept it, and merchants won't accept it if consumers don't use it. Square's genius is that they control both sides of the market. They have over 4 million merchants and a massive user base of Cash App. So this 2-year zero-fee period isn't about saving money. It's a Trojan horse. It's a strategy to build out the merchant side of the network at virtually no cost. The next logical step, in my opinion, will be to incentivize Cash App users to spend their Bitcoin. Once that loop is closed, you have a low-cost payment system that completely bypasses the traditional credit card networks. This could be the most significant real-world experiment we've seen turning Bitcoin from digital gold into everyday money, and it's something we absolutely have to watch. Speaking of institutional players changing the game, this next story is the perfect example. The spot ETF battles for Bitcoin and Ethereum have already turned into a bloodbath, and now the war is expanding to altcoins. The latest news is that an investment firm called Canary Capital has submitted the final amended filings for spot ETFs for both Litecoin and Hedera, or HBAR. This is basically a done deal. The top ETF analysts over at Bloomberg, guys like Eric Balchunas, are saying it feels like these are at the goal line. The filings even include the ticker symbols and management fees. LTCC for Litecoin and HBR for HBAR, both with a 0.95% fee. Now, that fee is the most interesting part. 0.95%. Compared to the Bitcoin ETFs, which have fought a price war down to around 0.2%, that's incredibly expensive. But if you think about it, this signals a new trend. For these altcoins being packaged into an ETF for the first time, the issuers aren't competing on price, they're competing for first mover advantage. Whoever gets listed first captures the biggest prize. What we're seeing is the formation of a tiered crypto ETF market. Tier 1 is Bitcoin and Ethereum. That's the playground for giants like BlackRock. A low-margin, high-volume game. But Tier 2, with coins like Litecoin and HBAR, is different. These ETFs are like niche access tickets, and they come with much healthier profit margins for the issuers. More importantly, once these altcoins have their own ETFs, it's like getting an official stamp of approval from the SEC. Financial advisors can then comfortably recommend them to their high net worth clients. Can you imagine the amount of capital that unlocks? For any altcoin that successfully makes this leap, it could trigger a fundamental revaluation of its worth. For our next story, we're shifting our focus to the Solana ecosystem, where a war of independence is brewing that could reshape the entire DeFi landscape. Jupiter Solana's largest DEX aggregator has announced it's teaming up with the stablecoin powerhouse Ethena to launch a native stablecoin called JupUSD in the fourth quarter of 2025. Now this is where it gets interesting. JupUSD is coming out of the gate with a premium pedigree. It will be 100% backed by another Ethena stablecoin, USDTB, whose collateral is primarily held in tokenized US treasuries through BlackRock's BUIDO fund. In other words, this is a stablecoin backed by real-world assets. But the real power play is this. Jupiter announced it plans to progressively convert roughly $750 million of USDC from its liquidity provider pool into its own JupUSD. What does that signal? To me, this is nothing short of a declaration of financial independence. As we all know, Solana's DeFi ecosystem is heavily reliant on assets bridged over from Ethereum, especially USDC. This dependency is like handing over your financial lifeline to a competitor. It not only introduces risks like bridge exploits, but also means value like transaction fees, constantly leaks back to the Ethereum ecosystem. By creating a native RWA-backed stablecoin, Solana is building its own financial foundation. Swapping out $750 million of USDC is a clear message to the world. We're done working for the other guy. We're building our own financial system. This move could ignite a full-blown stablecoin war among the major layer 1 second. In the next phase of DeFi, the chains with their own powerful native stablecoins will be the ones left standing. Let's move on to some news from the Web3 social space, a sector that's always had a lot of hype but not a lot of killer apps. However, a recent move from Farcaster makes me think the game is about to change. Farcaster, the decentralized social protocol, just announced that it has officially integrated the BNB chain. Now you might hear that and think, so what? They just added another chain. But if you connect the dots on Farcaster's recent moves, you'll see a massive ambition taking shape. Before this, they had already integrated Solana and a whole bunch of Ethereum layer 2 seconds. The founder, Dan Romero, laid it out clearly. The short-term goal is to support every important chain and asset, enable instant, bridgeless swaps, and get transaction fees as close to zero as possible. The underlying logic here is what makes Farcaster so formidable. It's a completely different beast compared to X or Facebook. Web2 social platforms lock all your data and your social graph into their walled gardens. Farcaster, on the other hand, is designed to be a base protocol, like the SMTP protocol for email. Your core identity is on-chain, but all the high-volume data, your posts, your follows, is stored on a decentralized network called Snapchain. Are you seeing the picture? Farcaster isn't trying to build another social app. It's building the universal social layer for the entire Web3 world. Their strategy is to make all the major blockchains their infrastructure, so that when you're using a Farcaster-based app, you don't even know or care which chain you're on. If they pull this off, the so-called layer 1 social wars will be over before they even begin. Farcaster will become the essential social gateway that every chain has to plug into, capturing the value of the entire sector at the protocol level. That, my friends, is a true checkmate move. Finally, let's look at a piece of on-chain data that might completely change how you see the current market. Bitcoin hit a new all-time high of $126,000 this week. Normally, you'd expect a frenzy of selling and profit-taking at these levels, right? But I just read a report from the on-chain analytics firm CryptoQuant, and honestly, it's completely counterintuitive. The report shows that profit-taking activity is unusually low. Let's look at the numbers. Over the last 30 days, the total realized profit was only half of the peak we saw back in July. Short-term holders, who we usually see as the speculative force in the market, are realizing profit margins of only about 2%. That's nowhere near the 8% or higher we typically see at market tops. And here's the most telling part. The OGs, the addresses that have been holding for over 10 years, have only sold 5,000 Bitcoin in the last month. That's just half of what they sold at previous peaks. What does this all mean? It means the vast majority of holders, especially the most committed ones, are choosing to hold their bags, even at all-time highs. This is a complete reversal of the old bull market script. Previous tops were defined by early investors distributing their coins to a flood of retail FOMO, which caused the short-term holder profitability to skyrocket. But now, the dominant new money in the market is patient capital coming through ETFs. They aren't here for a quick trade, they have a much longer time horizon and aren't easily shaken out by a 2x or 3x gain. This suggests that the on-chain indicators we've always used to call market tops might be becoming obsolete. The new signal for a top might not be retail euphoria on-chain, but rather sustained large-scale outflows from institutional ETFs. Alright, that's all for today's Web3 Daily. If you found this helpful, please hit that like button to show your support. Every day, we sift through the noise to bring you the most critical and actionable insights from the Web3 world, the news closest to the money. Our goal is to help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges in the description below.
These are special high rebate deals we've secured for our viewers to help you save on trading costs. Let's all stay rational, move steadily, and build wealth together in the world of Web3.
May your crypto portfolios grow steadily. We'll see you tomorrow.